So why don't you explain? Because it was quite a wild weekend. As the week went on, it got wilder and wilder.
Well, I think, David, let's just start with, two words, interest rates. So to put some context into what happened this week, let's consider the following. Since the end of July, so over the past 3 months, you've seen the nominal S&P, the nominal 10-year yield move from roughly 4% to approaching 5% as recently as a week or so ago. In the meantime, real yields moved from roughly 1.5% up to 2.5%. This had a couple of profound impact on the S&P. First, what it did was increase the concern regarding the economic read-through to rising rates. Second, yes, it had some valuation influence on the broader market. But then third, it also increased the concern about even higher rates and the implications that may have for our growing deficit situation. So this week, essentially, what happened, to your point, you took 10-year yields down in the response to some of the economic data, Fed commentary, and essentially you snapped the rubber band that had been getting stretched pretty wide as the S&P had pulled back roughly 10% over that time frame.
And you have a chart that we'll put up for our television audience, actually, showing that rubber band snapping back, which is the relative yield between stocks and bonds, essentially to simplify the chart, that we'll show our TV audience.
Yeah, essentially what's been happening here is as rates have backed up, our cross-asset valuation work has increasingly favored fixed income or bonds. And so essentially, as you look at the opportunity in, say, a 5-year, 10-year yield versus the expected return on the S&P 500 or U.S. equities, it's increasingly skewed in favor of, hey, why didn't I stay in bonds, whether it be short-term via money market funds where the Fed funds rate is, or longer-term out to the 10-year yield. And so our point here is that that concern, we think, has kept a lot of flow headwind on U.S. equities. And again, combined with this pullback in 10-year yields this week, you've triggered a snapback that has had the effect of drawing money back into equities very quickly.
Scott, it strikes me through that really lucid explanation of the week, there wasn't that much reference to the Fed and what they're doing the rates. I mean, sure, we had a news conference with Chair Jay Powell, and they came out with a decision not to do anything. But how much of this is really a matter of federal funds rates as opposed to other macro factors right now?
Yeah, so I think the federal funds situation, I think most investors have gotten comfortable that if we're not at a Fed fund peak, we're awfully close, right? And so whether the Fed decided to put another 25 basis points on or not was certainly relevant. But in our view, it's kind of paled in comparison to what's been happening within the bond market internals, where this move in the 10-year yields is probably more indicative of the rate that you would use for evaluating future projects on a company-by-company basis, how you think about this, again, stock versus bond math, and increasingly how you think about the longer-term valuation setup for equities. And so, yes, Fed funds is very important here. Our focus for the past month or longer has really been more so on the 10-year yield component as the culmination of all these issues that are coming into play right now.
And Scott, you are an equities guy after all. We're in the middle of earnings season right now. What about the fundamentals on the earnings? Are they playing in this at all?
Well, there's two sides to this. We've been of the view for, over a year now that earnings resilience is going to be a hallmark of the current equity market setup. And we got that with the Q3 reporting period. If you look at the top 50 market caps within the S&P, 48 have reported, 44 have beat expectations on average by 8%. We think the fundamental setup for the U.S. equity market's in pretty good shape here. Now, what we did get in terms of upside surprise with Q3 results, we gave back to a certain degree in Q4 expectations. Again, not a surprise, given where rates are, given where the Fed is, given the geopolitical circumstance, not a surprise to see corporates remain fairly cautious on the outlook. Given what we know about economic trajectory right now, we think this sets up for another positive surprise going into the Q4 reporting period, still a couple of months away.
And finally, Scott, we're fortunate to count you as a Bloomberg elf. You're at 4,600 is your call for the end of the year, well above the median call of 4,435. Are you inclined to raise that or lower it, or where are you?
Look, I think it's still a stretch. We thought it was more of a stretch a week or so ago, but now we're within 5% of that. So I think we're going to hold that, and we're going to use that as a stopping point, if you will, in terms of where we think this year can go. We're still quite bullish going into the first half of next year, David, and our ongoing view, kind of playing on this earnings resilience theme, is that we actually think the S&P is positioned to show pretty decent earnings growth in 2024, and potentially even in the face of a mild recession circumstance. So color us bullish on S&P 500 fundamentals. We think this will play through into the 2024 earnings outlook, which becomes more important as we wrap up this year.